What should investors know when it comes to today's uncertain marketplace? Our market monitor guest has some ideas. Erin Gibbs joins us. She's Equity Chief Investment Officer at S&P Capital IQ. Erin, nice to have you here in person.
Thank you.
I don't know that we've ever sat in person. I've met you over the television, but not here. Let's begin tonight with the unfolding developments in Paris.
Yes.
What we know is much smaller than what we don't know about the origin, who will claim responsibility for this, indeed the death toll. We do know that more than 36 have perished so far. How does this change your investing thesis, if it does, over the next 6 months?
Well, as you said, it's very early, but right now, typically these types of very scary types of threats often don't have that much of a long-term impact on the stock market and our investing. It does seem to be very focused, so I don't see any really immediate impact. We can certainly see more volatility in the markets over the next coming weeks just because the fear gauge is a little higher. People might be a little quicker to move out. But from an economic standpoint, it really doesn't have a big impact overall.
John Kilduff, who was just here in our prior segment, said that he sees it a different way. He thinks that in the wake of events like this, people tend to do less. They stay home more. They travel less. They may feel a little more protective of their assets and take a more defensive posture. Do you see it that way? I guess not.
It tends to flesh out very quickly. We tend to have, for me at least, we tend to have fairly short-term memories, particularly when it's something that's so far off as in Paris versus if it was much more localized within the U.S. Like I said, you could see more volatility and you could see people scaling back, but particularly if this tends to be one isolated incident, we don't see more incidents going forward. It just all happens tonight. I could certainly see this being fleshed out within a couple of weeks. And you see that with wars, too, and that it tends to just take a few weeks and people tend to go back to their normal patterns.
Let's take a look at quickly 3 of the stocks that you like right now. These are very consumer-facing companies, leading with Apple, which has had a rough week.
It has, and I recommend it as a really good value, high-quality stock. Right now, we're expecting about 7% earnings growth over the next year. So if the price just stays on track of where its earnings growth is, you could see that 7% appreciation, on top of the fact that it's actually trading at a pretty big discount to where we've been seeing it over the past 3 years. So between the discount and good, decent earnings growth, I could see this stock easily going up another 10 to 15%.
Quick thought on Walt Disney. Who doesn't like Disney? Huh?
Who doesn't like Disney? Disney is one of these great growth stories. One, again, another high quality, long-term type of holding. But one of the things that we're really seeing potential growth for is they've acquired Star Wars as well as Marvel's Avengers. And it's not just the revenues from those films per se, but the products relating to the films, the toys, the clothes. We saw a huge amount, the merchandise, and so we saw just an enormous amount of revenue attached to their Frozen franchise, and we see the potential, particularly with the Star Wars going forward.
All right, Erin, we have to leave it there on this very busy night. I should point out that your third pick is Foot Locker, and you say it's not just men's athletic shoes anymore.
That's right.
Erin Gibbs, thank you very much.
Thank
Appreciate
you
you being with us this evening.